Hey everybody, good morning, sort of from New York, and thank you for joining us here today. Good morning, afternoon, noon soon, Mark, who's in Toronto.
Thank you, Danny. Great to be here.
Thank you for being here today. And while Mark is in Toronto, his heart is in the Tel Aviv beaches, as you can see behind him. I just recognize the picture behind. Even though I'm in New York, I do miss the beaches we have in Tel Aviv. Um, I'm happy to have Mark with us today, and I'm going to just give a brief overview of Mark's very exciting bio here. And I think what amazes me the most, I've met, in my business, as you know, we're doing conferences all around the world. I've met many VCs and entrepreneurs, and I don't think I've ever met somebody who managed to build a company into a very, very successful exit without taking one single penny from outside investors. Now he's taken, after several other exits, is doing his own fund, which is very exciting. And let me just read a little bit about Mark here. So Mark Nashman is the Chief Investment Officer at iNcapital Ventures, a venture capital firm focused on early stage Israeli high-tech companies. Mark has extensive experience as both an operator and an investor in B2B enterprise software companies with expertise in identifying companies that are poised for growth. Together with iNcapital's deep pipeline of Israeli high-tech early stage ventures. What did I just read? Yes. Previously, Mark was the CEO of MBN Capital, a private office investment vehicle focused on B2B software companies. Mark is also actively involved in the community, holds an MBA and honors computer science from both from the University of Waterloo. And actually, the text is somehow, I'm missing the end of that text. Which was the second university, I'm sorry?
Both degrees are from University of
Oh, both
Western
degrees.
Ontario, actually.
Okay, so that's so.
Computer science and MBA.
Yeah,
So
yeah,
yes.
I did the comment in the right place here. So we will soon speak about his life and work and tremendous success. Maybe we'll start by asking you, Mark. You were one of the co-founders of Clarity Systems, which is the firm I was referring to. And after growing the company for 15 years, and I remember speaking and learning about your firm that you actually built and had investments coming from your own sales and no internal capital. You were acquired by IBM. Tell us about Clarity Systems products and services, and let's start the discussion there.
Sure. So Clarity Systems, we were founded in 1996. Eventually, were acquired in 2010. By the end of our journey, we had two main product lines. We sold solutions to the Office of Finance, so finance departments of large and mid-sized companies. And we sold typically budgeting planning solutions to help companies do their annual budgeting processes and automate that process, as well as automating the external financial reporting processes. And so we help do SEC filings in the US, filings in the Companies House in the UK, CEDAR filings in Canada, et cetera. And by the time we were acquired, our customers included over half of the Fortune 500. We had operations in North America, Europe, and Asia, and a little over 400 people in the company, which is quite a good size for a software company. So quite a nice run over those 15 years.
Thank you. And how were you able to grow Clarity Systems without outside financing and without taking on debt? And this is unheard of. I mean, again, I had the pleasure of having some of the world's leading entrepreneurs, like Uri Levin from Waze and Dov Moran that invented the flash drive, and many, many, many other very successful entrepreneurs with huge companies that were heavily diluted. And you managed to do it without a dime.
Yeah, so these days, and even back then, to start a software company requires capital. And so we didn't actually start as a software company. We started as a consulting firm. And myself, my business partner, our backgrounds were both in computer science, an MBA. We were already independent consultants working in the field just independently. And we came across some really cool new technologies, some database technologies that helped in business analytics. And what we did is we started a company to do consulting around this new technology. And it was a pretty hot space. There were a lot of companies interested in this. And at that time, outsourcing to get expertise in an area was a trend that was growing nicely. And so what we did is we would find projects, sell that work, and then quickly find people to do the work. And so we would hire people to do the work in front of us. So we already had sold the work. We kind of get the thing started, hire more people to backfill us, and then do the next project, et cetera. So the projects that we were selling into were funding our growth and funding the hiring of people. We didn't have outside finance. It really didn't occur to us to focus on that, as focus on just growing the business. And so we had to make sure that each project was profitable, able to pay that person's salary, make a good margin for ourselves as well. So just as a software or as a consulting firm, we grew to over 50 people this way, just building more and more projects along that process. And the company was profitable, covered everyone's salary, and kept growing without the need to raise outside capital. So we had this inertia as a consulting firm before we became a software company.
By the way, you had partners. How did that look like?
Yeah, so I started the company with a business partner. His name is Frank Pizzolato, a great guy, very talented, and we worked together great for 15 years. And he had a similar background to mine, and our skills complement each other in terms of helping to get this company started. So it was really the two of us.
Amazing. So Clarity started as a consulting company, evolving into software. How did you manage that transition from consulting to software?
Yeah, managing or growing a consulting firm and growing a software company are two very different animals. And that transition is not easy. For us, what happened is, as we were doing our consulting projects, we ended up doing the same kind of projects over and over. And so we built up a toolkit of software tools to make that process quicker and easier. So initially we would sell our consulting and we would support that with a toolkit, maybe charge a little bit extra for the toolkit. And then in around 2000, 2001, after we've been in business 4 or 5 years, we started to more formally internally invest in our software platform. And so we extended our toolkit to become more of the core software platform that grew into what Clarity Systems eventually was focused on selling. And in that transition, you have to start to build up all the parts of a software company that are not typically part of a consulting firm. So by the end of our journey, we had a very large and strong software development team, a separate product management team that would oversee the direction and the roadmap for our product development and keep in touch with the customer's needs, a proper QA department to maintain proper quality for our software applications, customer support to answer all the questions, a formal sales department with inside sales for lead generation and cold calling, outside sales for closing the deals, pre-sales engineers to do all the demos, an RFP team to answer public tenders that we were responding to, a formal marketing department, and then deep relationships with all the analysts in the industry, as well as all the typical head office functions. So we evolved from a very kind of narrowly consulting firm focused company, which is a much simpler model compared to where we evolved to as a software company. And in that transition, it's tricky to get the right people and build that organization. We learned a lot about what it takes to build that kind of a company from hands-on learning.
I see here our friend Kenneth Field. I'm not sure if you've met another very successful Canadian entrepreneur. Is asking a very direct question. Why did you sell?
Why do we sell IM? Well, it's a great question. We had grown over 13, 14 years by the time we started thinking about selling. And we had seen many of our competitors get acquired over the years. And we thought, and we saw some high price tags for those acquisitions. We thought, I don't know why that company bought that thing at that high a price. Our product's way better, our team is better, our customers are happier, etc. And we thought, it made sense. We were profitable, we were growing, we didn't need to sell, which is a very good place to be when you are trying to sell your company. But we thought it just made sense to look at the market and consider the options in front of us. And so we didn't start the process thinking we have to sell or it's our primary focus to sell. It was really, if there's a way to sell for a good price and really secure our family's financial wealth for now and quite a long time, it's hard not to consider it. We like the company, we like what we were doing, so there's no need to sell. But then it evolved into a really good opportunity that worked out well for all of us. So that's really how it evolved.
I see more questions. We'll get to it in a second here about your work with Clarity. Clarity System was founded in '96 and you sold the company in 2010. You managed the company through the dot-com bubble and through the 2008 financial crisis. How did you guys survive those market downturns?
So first of all, because we didn't have outside debt or outside financing, we didn't have external financial pressure to respond in some way, or we had to meet certain covenants, etc. The main issue for us was to make sure we sold enough business to cover our overhead. And so in the dot-com bubble, we still had a number of large consulting projects that were ongoing, and we were able to sell extensions to those projects and upgrade of services to some of our customers and sold a few new projects along the way. But certainly the market was softer in the dot-com era. And we had to be careful in terms of our overhead. We didn't really let many people go. It was really just to tighten things up, manage costs, focus on selling what we could, and kind of survive that downturn. And then as our software started to evolve, we started to get new business that we controlled the sales cycle even more so by controlling both the software and the services side of it. And so we grew out of that nicely. In the 2008 financial crisis, we were actually growing quite nicely through that crisis because what we were selling was still in high demand, even though the market overall was very soft. And it's because we sold processes to help automate the external financial reporting process. And prior to our solution, most companies, the vast majority, were still using manual tools like Excel and Word to produce their most important documents. So these large companies would have these large ERP systems and operational systems to run the business. But when it came to filing with the SEC, those very important documents, they'd export data to Excel and Word and manually prepare them. And our tools help to automate that process, add controls, and support collaboration, which were really hot button topics around the 08 and 09 crisis, when people were looking for better controls and better assurance around their financial numbers. So we were growing quite nicely through that crisis, even though the overall market was in turmoil.
And by the way, the big guys didn't see it coming. They didn't see there's a need, there's a gap that needs to be filled that you guys were focusing on?
The big guys, from my impression, they have a harder time to innovate and to respond quickly. And so they didn't really see it coming until after we were in the market for a while. And then they wanted to catch up. And the tools and the ways in which they approached it weren't the right way to gather customers as quickly as we were. And we were riding a wave of regulatory support where the SEC had mandated a new format that all these companies had to provide called XBRL. And because we could do that more efficiently and manage the overall process, we just got a lot of traction really quickly. and got a lot of attention by the big guys just by what we were doing.
And by the way, another question, you work directly with the companies themselves. What about those that had the CPAs do the work for them and reports? So CPAs were also your clients in that sense?
So at the end of the day, the CFO has to attest to the numbers, and the finance team does a lot of the work, whether or not they outsource it to what was called a financial printer or not. The internal teams prepare all the statements and do a first cut of all that stuff. And we automate all that process and produce the final filing and this new format called XBRL. And so we worked with printers. We actually partnered with some of the leading printers at the time as well. And we worked directly with the companies. So it was a very flexible way to collaborate, both internal finance teams and external finance teams.
And your clients were not just Canadian companies?
Yeah, our focus was mostly on the US companies. We had Canadian customers as well. But from early on, the market was just better in the US. The dollar was worth more. You could sell the same kind of number price in the US or Canada, get a larger value in the US. The market's bigger. They adopt technology more easily. In fact, it's easier to sell into the US first and then come back and sell in Canada because the Canadians are a bit more conservative in trying to adopt new technology from my experience.
Now, how did you prepare the company to be acquired in terms of building an effective team and positioning the company for a successful exit?
Yeah, so in 2008, 2009, we started considering selling the company because of the great traction we were having, and we thought it's time to consider that as an outcome. And as we looked internally, we saw there were some departments needed to be upgraded, and so we kind of upgraded our team a little bit. We found that our finance department is ironic because we helped all these other large companies improve their financial reporting, but our internal reporting was not very good at all. And we had a bunch of stuff to clean up. And you can't really go to market and try to sell the company unless you have tight numbers and you can really attest to the validity of where you're at and how you're growing, et cetera. So that took us 6 to 12 months to get organized as we were preparing. And then we felt we were ready to engage in the process.
Thank you. What are your thoughts regarding the pros and cons of using an investment banker? What do you look for when selecting an appropriate investment banker in an M&A process?
Yeah, so we decided early on to get an investment banker to help us in the process. We didn't have experience at the time in terms of how to sell a company, how to run the process, how to manage the process effectively. So we interviewed the large firms out there, 3 or 4 of the large M&A firms, as well as a bunch of boutique firms. And what was key for us was making sure that the key head of the M&A process for us, the key banker that we're working with, is going to be with us through the process, and not just from a bait and switch perspective where you meet the key guy, a few meetings, and they show up once or twice during the process. We wanted that key person to be on our file and working pretty much with every interaction with the potential buyers. And so we got that commitment and we got that assurance from one of the boutique firms. And so we selected one of those out of Silicon Valley, and they did a really good job for us.
And I understand that there were a number of ups and downs in the M&A process that Clarity went through. Tell us how the M&A process evolved.
It was quite interesting. We were a well-known firm in our space at the time. So we got interest by the strategic players. Oracle, SAP, and IBM all offered bids for us. And as well as our investment banker brought us to a number of the private equity firms. So we had bids from them as well. Initially, Oracle's offer was much lower than we were interested, so we discarded that fairly soon. But SAP came forward with a good offer, and we engaged with them quite heavily. In fact, in about January, February of 2010, we started the process with them. We actually went through complete price negotiation, agreed on the price of the company, entered into formal due diligence, and we did all the legal work, all the technical due diligence, etc. We drafted final paperwork, and we were about 12 hours before signing and final approval. We had booked a press release. We had booked an analyst call to explain the acquisition. We had booked an all-team meeting within our company to explain the acquisition. And then SAP pulled the plug 12 hours before that. Back in Germany, the board there didn't want to do it. We learned later it was some internal political issue around it. And so they kind of backed off on completing the acquisition, which was quite a shock to us because we were given assurance all the way along that it was all teed up. It was like a rubber stamp to be done at that point. Anyway, there was a lot of turmoil after that. This is now late May of 2010. And then into June, a window opened up for IBM to come back in because the exclusivity period expired with SAP. IBM was now in a position to acquire companies because back in the winter when we first spoke to them, they had other internal stuff. They weren't ready to do a deal at that time. But they came forward and we started the process with them. We got even a higher price with them and then ended up closing with IBM in October of 2010. So quite interesting process. You'll learn a lot about all the ups and downs in a deal and how a deal is never done until it's really done. But a great learning experience and a great outcome.
Yeah, and in the end, you ended up getting more from IBM than you would have if you would have gone with SAP.
Yes, exactly. So it worked out very nicely.
And mentally, by the way, how does that look like? Are you like, is that a period of time where you're stressed and over the edge, or because you're not, I mean, you want to sell, but you don't have to sell. It keeps you, going, like you should. How stressful was it for you, this period of time?
Yeah, so throughout the process, we were trying hard not to focus only on the M&A and really run the business and grow our customer base, keep customers happy, etc. And so it was definitely a shock when SAP didn't acquire us, but we really had mixed emotions about selling at that time. It was a good price, but we love what we're doing as well. And so it wasn't as big a blow as if we were, coming up to our last dollar. We had to raise capital and all that stress as well. We were a profitable company, still growing nicely in a good market. So, and then on the IBM process started up, that seemed even better. So it was, in hindsight, it probably could have been more stressful, but we were not that stressed out about all these ups and downs.
Now, last question about clarity before we go to actually why we're here for and what you're planning on doing now, which is exciting. So after Clarity was acquired, what was your experience like moving from the owner of an independent software company to becoming an employee with IBM?
Yeah, so it's quite a change, definitely. IBM is a great company to work for, great company to be acquired by, very ethical, and kind of they follow through on what they say they're going to do. They offered myself and the other key leaders in the company a retention package of about 3 years to kind of incent us to stay with IBM. But soon after the acquisition, I found that being part of the big blue machine wasn't really, right for me. I have a more of an entrepreneurial spirit than fit within the IBM culture. So I ended up staying for 8 months within IBM to kind of shepherd a transition process, make sure all the key leaders found good homes within IBM. And then I left to consider what the next step might be in my career.
So basically what you're saying is what I'm seeing with the different entrepreneurs that I'm seeing. You just never rest, right? I mean, you finally could have had a period of time where you can take it easy, you're, no risk. It's not your company. You can be a part of something, getting paid well, take a couple of years, to take it easy before, getting into something different again. And yet 8 months was as much as you could take it as an employee.
That's pretty much correct, yeah.
And maybe just one question from one of our attendees that has to do with clarity and brings me to my next topic, which is IInCapital, and the other exits you were involved with. But so somebody's asking, do you think you can do this again? Be competitive with all the venture capital dry powder in the market to grow fast now?
Yeah, so from IInCapital Ventures, definitely, we'll go into it later on in our discussion, but I think we're really well positioned to do well and have a very successful fund. In terms of being able to start a new company and do the Clarity Systems run again. I don't know if I'm up for that. That's a lot of work. It's a lot of, I mean, I think I could do it, but I don't think I'd want to do that. I think I like what I'm doing now in the venture capital space a lot more. You get to see a lot more deals, and you have a lot of hungry teams that can do the legwork for you, and you provide the guidance needed to help them be successful.
So, okay, so let's move to our next topic. So after you sold Clarity, you started to invest in early stage tech companies. And by the way, this is a very interesting point that I also see a lot in my conversations. Whenever several of our speakers and presenters are groups that were at one time great entrepreneurs and now are suddenly investors. So on one hand, people are saying, "Oh, great, the guy made it big time. You should know what he's doing." But on the other, they're saying, "Hey, an entrepreneur is not an investor. It's two different things." And I think in your case, you proved that you can do that well, also from the other side of things. So you sold Clarity. You started to invest in early stage tech companies from your own personal money, I believe. What types of companies did you focus on, and why? And if you can give us an example of one of your portfolio companies that you've invested in.
Sure. So our experience was around B2B enterprise software companies. So it just made sense to continue to focus in that area. For example, if I saw a healthcare opportunity or an agri-tech opportunity, I wouldn't be able to evaluate that. I just wanted to stay away from those. And so I started to look for early stage B2B enterprise software companies where I could provide guidance, some capital, and help them grow. And over about a 7-8 year window, our family office invested in 10 early stage tech companies. 3 of them have exited already. And they've done overall quite well. So one was, for example, in the advertising space. There was a mobile advertising tech platform. When I first saw them, it was very early stage, and they had this core intellectual property of being able to take a tweet, a Twitter tweet or a text, and infer the emotion from that tweet, which I thought was pretty cool. But how do you wrap a business around that core IP? And after a number of months of meetings and building a team of advisors around them, we came up with the idea of focusing that core IP around a mobile advertising platform where the company would be able to sell to brands and let them reach customers based on what they're saying, the emotions they're exhibiting, what they're saying, where they're located, demographics, and they could target people who would tweet something about a certain topic, and within half an hour, an ad would hit them based on that topic. So very focused, targeted advertising. The company did really well, and we had an over 20x exit on that investment. So really happy with that.
Amazing. So let's talk about IInCapital Ventures, which is really the topic of our discussion, a new fund. You recently launched the VC, and you are focusing on Israeli tech companies. Why Israel?
Yeah, it's a great question. In the past, in our family office, we were focusing mostly on the Toronto ecosystem because I'm based in Toronto and had a network here. But as we were looking to launch our fund, we first of all had a great network through one of our partners in Israel. And the Israeli tech ecosystem is just a fantastic place to invest. They've got great teams. And so many of you might know in the IDF, the Israeli Defense Force, is a unit called 8200, which is their tech and cyber units. And so as high school kids enter the Army, they're vetted, and a lot of the ones who are most aptitude for tech and that kind of ecosystem get pulled into 8200 and learn a lot of skills in terms of team building, leadership skills, and deep tech skills, and then come out of that process, I find more mature and ready to really do great things. And we've just seen a lot of deep tech solutions coming out of Israel as a result of that, with really strong quality teams. And then there's a lot of capital. As one of the questions alluded to, there is a lot of capital in the market today, and particularly in Israel. And so there's funding available to get a company started, to go through the early stage Series A, B, and even to grow into unicorns. And so it's a good ecosystem to invest both in terms of talent, the ideas, and the capital to support it. The government funding supports it further with the Chief Scientist Office. And as a result, the country has a great track record of success, I think with the highest number of unicorns per capita of any country in the world. So we're happy to be there, and we're doing quite well with our investments there so far.
And what's your investment thesis? What types of companies you're looking to invest in?
So again, given our background, we focus on B2B enterprise software companies. It's what we know how to evaluate, know how to help coach and grow, and know when the right time to sell is. And so we really focus on those kind of companies. And in terms of stage, we focus on Series A, Series B financing level. We're looking for companies with typically around 2 million in recurring revenue already before we invest, so that there's a proven product market fit. We have customers that use their products, that are renewing the products, that can attest to the value, and their renewal of their licenses is a strong indication that they like the product and see value in it. And of course, we're looking for these strong teams. We want to be careful to look at the customer base. There's a very low churn rate, so very high sticky solutions that are going to last for a while in those companies. And then some kind of deep IP or some kind of a moat to protect these companies as they grow, to differentiate them, to allow them to grow bigger, and also to be acquired by another company in the space that's looking to acquire that core technology to embed into their larger organization. So from a sector perspective, we're kind of agnostic. We invest across AI, machine learning, IoT, cybersecurity, BI, fintech, et cetera. But we avoid, so all the techie areas that match, kind of like, for example, my background in computer science and my experience, I can understand these tools. Whereas again, healthcare, agri-tech, other areas that are not kind of well understood by our team are areas we stay away from.
By the way, how do you see crypto space?
Yeah, so cryptocurrencies is a really interesting space that I know no more than anyone else. And so I'm not going to invest in that space because I can't tell what's going to be hot or not. Whenever something's going to be, really hot and everyone's going to like it all of a sudden, it's a B2C space or that area like that, I stay away from. I know B2B enterprise software, that's what we focus on.
You were investing in early stage tech companies with your family office privately. Now you're investing in early tech companies via fund. Is there any overlap or conflict here?
Yeah, there's no conflict because we stopped doing any more VC investing through our family office. We invested capital, significant capital into the fund, and all of our go forward investments are through the fund. So there's no conflict of, cherry picking a deal to go to the family office or that kind of thing is not going to happen. All of our VC investing is through the fund.
And you invested some of your capital in that fund?
Yeah, so the fund is a 50 million target fund. We've committed 10 million of our own capital to the fund, which is a very high commitment. It's like a 20% of the fund commitment. Most VCs, it's a 1 or 2% allocation of GB commitment. But we did it to show our commitment to this space, and because we want to make a lot of money. We think this is a great way to invest and do well.
You're based in Toronto, which is why you have a picture of the Israeli beaches, because that's something you guys don't have yet. No, I'm kidding. You have great. I love Toronto. How do you get access to high quality deals in Israel? You mentioned you have somebody on the ground and an access, but if you can talk a little bit more about that.
Yeah, so we have a team in Israel. Inbar Hacham is our leader in Israel. She's one of the GPs of the fund. She's got over 12 years of experience in the VC sector. She led the US operations of Magma Ventures, another Israeli-focused VC. And she was chosen as one of the 10 most influential Israelis in New York City, because she was based in New York City for a while, representing that fund in New York. And now she's back in Israel. leading herself as a senior analyst there. And so she has a great extensive network, her and her team there, across entrepreneurs, investors, industry players, legal players, accounting players that provide deal flow. And so we've seen over 300 Israeli deals this year, and are just very selective in which ones we go after. But we see a high deal flow in terms of volume and high quality given our network.
I happen to have met, I had the pleasure of meeting in Bar many years ago, when she was, I believe, with Magna back in the day. So I was very much impressed. And there are a lot of VC firms investing in Israel today. How do you differentiate yourselves from the other guys?
Yes, there's a lot of capital and a lot of VC firms chasing these good deals in Israel. But often these companies are very selective in who they want on their cap table and which partners they want to bring to the table. So the way we differentiate ourselves is, first of all, we're at the table given the network of our team in Israel. And so we're going to have the opportunity to pitch ourselves. And then we'll talk about our operating experience, how we're not just investors of capital, that we can help in the go-to-market strategy and sales strategy, and that our network is based in North America. These companies like that we have a big operation in North America so that we can introduce them to good talent. They're looking to hire some of the team over here. They're typically looking to grow their sales marketing engine in North America to extend their growth. And so our experience and our network here is quite valuable to them, both in terms of talent to run the business and for introductions for additional capital down the road as they grow their teams. And so we compete on that basis. And we also have a great reputation of being able to help these companies grow and prosper. And so we find that these deals are made available to us and that we get into them because of what we offer. And I'd say all the deals we've done so far have been competitive. And we were selected over other VCs due to how we work with these companies and add value to them.
And where are you guys now? Have you made any deals yet? Which sectors have you already invested in? Where are you at with all of that? Capital raised?
Yeah, so we've done 7 deals so far. Again, I said it's a $50 million fund. We've raised $35 million or so of committed capital. So another 10 or 15 more million left to go in our fundraising process. We've already deployed 15.2 million of that in 7 deals across various sectors. So we have 2 deals in AI, machine learning, 1 in IoT, the Internet of Things, 1 cybersecurity company, 1 fintech investments, a marketing tech investment, and 1 in the identity and access management space. I could go into extensive detail in each of these deals, but I'll hold that for another time probably. But we like this spread across multiple sectors so that we're not exposed to any sector risk more than we would need to be. And all these are common deals in the sense that they're all enterprise software companies looking to grow. Typically the core IP is based in Israel, and operations are trying to grow extensively in North America and around the world. And we help in that process. Although we're not limited to only Israeli investments, that's just our focus area of where most of our pipeline is located.
Now, how did COVID affected your companies? How did they manage to survive during this time? And maybe I'll also ask if you see better opportunities due to COVID, like better valuations, or not really. At the end of the day, it doesn't really affect that with the good companies. So basically, how COVID affected your world?
Sure. So when COVID hit a little over a year ago, all the companies across sectors were very concerned on what's this going to mean for them. The lockdowns were occurring, and there's a lot of, or just very little visibility of what's going to happen. And so companies were drawing on their open lines of credit to build their cash reserves, make sure they have enough on the balance sheet to support them through this process. We looked at our portfolio companies, and most of them had over 24 months of runway available. Some had just done a fundraising round, some were trying to close some. But they were all overall quite well capitalized. That wasn't an immediate concern for us. And then as COVID played out, we found Q2 of last year was quite soft, but from Q3 onward, traction picked up and the tech sector overall was doing quite well. So overall, our companies were doing quite well through that. But we did see some good investments and did one deal right in the midst of COVID-19. There's a fintech company that already had a large client base, but they had been trying to raise capital just before COVID-19 hit. And they had offers at a very high valuation. We're trying to get that deal done. COVID came along and the whole deal evaporated. We came in and were able to invest at a much lower valuation because we saw past what COVID was going to do for this company. And now that company has doubled their revenue, they're cash flow positive, growing nicely. They're getting M&A interest from a number of parties. And so it was a great investment at a much discounted price. So we're really excited about that investment and one of the opportunities we were able to take advantage of due to COVID.
So you mentioned that a little bit, but any specific investment opportunities that COVID brought your way?
Yes, this one company is called Wellness Living. We invested in them last spring through the fund. And again, they've pretty much doubled their revenue since then. They have over 3,200 customers, really, really strong company, growing really nicely. Just announced some new partnerships, one with Barclays Bank in the UK just now. And so we were able to invest at a good valuation into a great company with a great leadership team.
So an Israeli company.
This was our one of the 7 companies. 6 are Israeli and 1 is in Canada, is based in Toronto. Wellness Living is the one based in Toronto that I've been tracking for a while. So we were able to capitalize on that opportunity. So as I said, we're focused on Israel, but that's the one that was a Canadian company.
Now, there is a lot of liquidity in the market these days. How has this affected valuations?
So valuations have come up since Q4 and Q1 of this year. We've seen valuations creeping up. And I see a lot of variation in valuations. You'll see some companies asking for really high multiples and others much more reasonable in their expectations. And we're just not gonna stretch ourselves to go after, even if it's a good company, if the valuation doesn't make sense. We're trying to be very disciplined in our approach to investing. We're going to follow our investment thesis. We have no great rush to deploy the capital. I want to make sure it's deployed effectively, and we've got a lot of our own capital in the fund, so we're not trying to chase deals just to get the deals done. We want each deal to be successful. And so although valuations are rising, you can still find good valuations if you're careful and structured in your approach to it.
What is the high-level structure of IInCapital Ventures in terms of fund size, etc.?
Yeah, so as I said, we're a $50 million target fund, that's US dollars. The fund is a Canadian limited partnership, so it's domiciled in Canada, but it's got a flow-through structure. So for investors who come in, any distributions would come out of Israel or out of Canada, tax-free. We have a ruling with the Israeli tax authority, so there's no withholding tax in Israel. The flow-through structure of the limited partnership in Canada is such that the gains would go to the investors and you just pay your capital gains tax based on your local jurisdiction. About a third of our investors are based in Canada, about a third of the capital is from Canada, a third from the US, and a third from Israel. So well diversified in terms of sources of capital for our fund. And again, we've raised 35 million so far, looking to raise an additional 15 million in capital. And so far we've deployed 15.2 million in capital across 7 deals.
Now, I assume you're not closed yet, so people can still join. And so if so, how does that work?
Yeah, so investors, we're still accepting new investors. The minimum check size is 250,000 US. as a minimum investment. And we're happy to talk to people about that. We'll be opening up the investments for another 2-3 months, and then we'll close the fund and just focus on deploying the capital and helping these companies grow.
Now, we talked about the fact that you guys invested your own capital, $10 million out of your family office. So if you could share a little bit more about that, that capital of yours funded what kind of investments, probably the first ones you went into? How did that look like?
Yeah, so we committed 10 million of our own capital to the fund. And the way it worked out is we actually deployed 7.2 million of our capital already. So our money went in first before we actually called capital from any of our investments. Oh, sorry, invested from any of our investors. So we funded the first number of deals with our own capital, and those investments have now had a chance to mature even before first close. Those companies have been able to grow in value so that our LPs get the benefit of those early investments. And by the way, those early investments were transferred into the fund at cost, of course, with no markup.
I know we have some questions. We'll get to it in a second. Someone asked to get a recording of this, so don't worry. We are recording this, and you will be able to. We'll send tomorrow the link to the recording as well as the contact information of IInCapital. So no worries there. I know that the fund has only recently been launched. How is the performance so far?
Yeah, so we did first close in October of 2020 last year. And most funds follow what's called a J curve, where there's negative returns for the first number of quarters until your investments have a chance to mature and grow in value. So like the cost to set the fund up, management fees have a bit of a drag on the performance. You have a little bit negative return, and then you go positive. Our fund's been different because we invested early on, even before we did our first capital call. We've now had 2 companies that have already been revalued higher. And that revaluation process is a standard process in the VC industry, where if there's a new round of financing with new investors that set the price for the company at a certain valuation, then you can revalue your shares at that new value. So only with third-party valuation do you then revalue your companies. So 2 of our companies have had new rounds of financing at higher rates. They're all doing really well. And so we've showed positive returns even from the start. Even our first quarterly report to our investors showed a positive return to the fund. Our fund now is up roughly 13%, which is great performance for an early fund.
If you've already raised 35 million in committed capital and you've already deployed 15 of that capital across 7 deals, how are new investors treated as compared to the initial set of investors?
Yes, so the new investors are treated just like the initial investors. So if we raise $1 of new capital today, you'll see that 13% gain that's in the fund now right away on day one. And so we're raising capital now at this as it was before. Again, that's only open for the next 2 or 3 months, then we'll be shutting down the fund. That's the process for a new investment, just like it was before with the original investors.
And last question, final thoughts that you'd like to share with us regarding IInCapital Ventures.
Yeah, so overall, we're really excited about the fund. The Israeli tech ecosystem is very hot. A lot of high quality deals doing really well. Valuations for tech overall are quite strong, so we see good growth in value and sales of our companies we've invested in. And we're getting access to really high quality deal flow. Inbar and her team have done a great job of bringing good deals to the table. And we like where we're investing. We like the Series A, Series B stage. We believe that area reduces the risk because these companies are proven. They've got proven ARR, proven traction, happy customers, but there's still a great upside where you can see a 10x return on your money on those really hot companies. And then we only invest in technology that we understand. Again, we focus on B2B enterprise software companies, an area we understand well, and think it's a great place to be investing.
Thank you. Now I want to see, we have several questions here. So let's start. How much do you invest in each company? Yeah, so that's one question.
Yeah, so the initial check size is typically between 1 to 2.5 million is our initial check size. We typically reserve half our capital for follow-on rounds. So depending on the opportunity, we'll do that. We always take a board position, either a voting board seat if we lead the round, or at the minimum, a board observer seat. So we have complete visibility into the company's performance. And we have active calls with our companies on whether it's weekly, monthly, quarterly, depends on the company where we're at, but we're engaged with these companies on a regular basis.
About what percentage of the target company do you try to acquire? Do you arrange an option to buy more at a later stage at a good price?
Yeah, so we're always going to reserve preemptive rights so that in a new round of financing, we can at least maintain our pro rata share. And for example, one of the companies just in a new round of financing, we were allocated more than our pro rata share, and it was a competitive round where there wasn't enough room for everyone to invest that wanted to invest. But because of the value we've been providing to the company, they reserved extra amount for us to increase our investment. So we maintain that preemptive right with each of our investments.
Interesting question here. Going back to Clarity, if you would have raised capital from VCs, do you think, now that you're on the other side of things, do you think you would have had an exit earlier? Would it have been worth it, do you think, to be diluted and get the help of VCs? Or in your case, Clarity was a very particular case where you just didn't need it. So I wonder. Or
yeah, the experience that I learned at Clarity System was invaluable to me in terms of how to operate a company, what it takes to grow a B2B enterprise software company. But in terms of how would it have done if it was VC backed? The VC backed model is a great model to get good returns. And I've learned a lot about investing through our family office times and now within Capital. And it's a better model to get a strong IRR because your time to value is shortened because you put the capital in, you can build a team quickly, get to market quickly, and get acquired quickly relative to the 15 years it took us at Clarity Systems. So I think at Clarity, if we would have been VC backed, we would have been acquired sooner. But in our specific case, the market opportunity of why we were acquired didn't really evolve until later in our cycle. Our external financial reporting solution didn't evolve until 2005, 2006, and didn't get traction until 07, 08, 09. And so we were at the right time at the right place to get acquired. Going forward as an investor, I like the VC model. I think you can take advantage of opportunities quickly, and you're going to get outpaced by a VC-backed company now, whereas it wasn't as prominent when we were first starting. So I think it's the right thing to do now. It would have been fine back then, but I can't complain. It was a great story back then as well.
What would you describe as your most successful investment to date?
Certainly Clarity Systems was the best investment to date. After that would be probably the mobile tech company with a 20x return. The two other exits in the fund were also good. And in our fund, there's a lot of strong companies there. I'm not sure which is the best. There's a number of good winners, but it's hard to know which is the best winner. But a lot of strong companies in the portfolio.
Is the entire $50 million to be allocated to Israel?
Again, our focus is on Israel, and we're going to be opportunistic elsewhere. So if through our network, we have opportunities in North America or elsewhere that we see are great, we'll invest there. But in terms of managing a pipeline of investment opportunities, our focus area is on our Israeli team and the network in Israel. And we think that provides our investors with a good understanding of where we're at, what we're focused on, which is the Israeli tech sector, B2B enterprise software. And we just think that market is a great place to fish for deals.
What is lock-up period for your fund, and can you project a specific return range?
Yeah, so the fund is a 10-year fund from first close back to October. We think the distribution will be happening much shorter than that, obviously. Our typical target hold period is 3 to 5 years. There's probably a few of the deals that'll be sold even before the 3-year window. There's early M&A interest in a few of them that we think will result in a distribution sooner. And so the net capital outflow would be probably much less than the total committed capital, because we raise capital on the commitment, we'll also be providing distributions as companies are acquired. So the overall return of the fund, we're looking to exceed the 30% that we saw in our family office with this IRR to our investors. And so our portfolio model of how we put together when we see exits would show over a 30% return. And so far, we think we're on track to having very strong returns in the fund.
Let's see, I'm answering another question here. What is the investment duration fund life? Okay, that's basically, we talked about that. Okay, I think this is about the questions I'm seeing here. Anything else, Mark, that you'd like to add at this stage?
No, it was a great opportunity to speak about the fund. If those who are interested, please reach out to us, either through Denny or I'm at Mark at IInCapitalVC.com. And we're happy to discuss the fund and where we're at and how you might participate.
Brilliant. And Mark, I'm looking forward to seeing you in person, hopefully very soon, at our events around the world. And yeah, that's that. I would like to thank everybody for being here. Tomorrow, I have a session about Broadway being back. One of my good friends, Wendy Fetterman, who's an award-winning Broadway producer, will be speaking with me tomorrow. Join me then. So thank you again, Mark. And as I mentioned, we will send the recording tomorrow to everybody alongside the contact information. So thank you, and we'll stay safe. Enjoy the summer.
Great, thank you.
Thank you. Bye-bye.